I don't think we lost many investors. I think the shock to most people is how well we held our asset. And so if you have a 5-year investment time horizon, yes, you move into our strategy. And oh, by the way, we are the new NASDAQ. I think that's the big threat. I think that's why Sundar went to Code Red.
In today's video, ARK CIO Cathie Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation. Before listening to her, please ensure to smash the like button and subscribe to the channel.
Cathie, you've talked about, though, the threat of deflation. So what's your view on that versus inflation right here?
A couple of things. We see the deflation in the pipeline because commodity prices, which are at the top of the funnel, have been coming down on balance. Now, we're seeing right now some interruptions in that as China moves away from its zero COVID policy. But I think the fake out here is China has been building inventories, particularly of energy. It's been getting Russia's energy for a 40% discount to what the rest of us are paying. So why wouldn't it build inventories? So I think that fear is probably going to be, or it has been, a little overblown in terms of ramifications for inflation. And I also don't think China's taking off. But anyway, we have the funnel. We had at holiday time massive discounting. And even though we had massive discounting in the fourth quarter, inventory accumulation accelerated. That was the biggest surprise to me. Wait a minute, final sales were that punk, that inventories built, even though retailers and others were trying to clear the shelves with these massive discounts. That was very interesting to me. So I think underlying demand here is basically the consumer is railing against price increases because real average wages have gone down. And the consumer is going to win this battle. He's saying what he should say as a Fed chairman who has been very concerned about inflation. He can't turn on a dime. But just look at what the bond market's saying. The long-term bond yield peaked in October at 4.3%. And today we got down to, I believe, 3.35%. You know, if you look at the 10-year bond yield as a proxy for what effectively nominal GDP, give or take a little, nominal GDP growth will be over the next 10 years. That doesn't leave a lot of room for much inflation if we're going to have real growth over the next 10 years. So I think the markets are speaking loudly. I think the inverted yield curve, we're still around 70 basis points. We haven't seen it this low since the early 80s when Volcker was trying to strangle inflation out of the system. The other reasons that we're very focused on this message that the bigger risk is deflation. It's also a very big opportunity. When we look at deflation, there's good deflation and there's bad deflation. The bad deflation is caused by demand destruction. The good deflation creates demand, and that is what our research is centered on, which is technologically enabled innovation that rides down learning curves, which are expressed by cost declines, which turn into price declines. You'll notice that Tesla is cutting prices, and many people jump to the conclusion that, oh, they're having so much trouble now. There's so much more competition. No, Tesla can cut prices now that supply chain issues are passing us because it is riding down a cost curve. The battery cost curve declines. And I think its battery costs are lower than anyone else's. Its drivetrain costs, is more correctly said, are lower than anyone's out there.
Right.
And so he wants to proliferate electric vehicles to save us from environmental disaster. That is his mission. And he is going to drive down prices. When you drive down prices, units explode. It's no surprise to us, even without price cuts last year, that electric vehicle demand was up more than 60%, while gas-powered demand was down, I believe, 7%. Yep. The consumer preference shift has occurred. We are now in prime time for electric vehicle. Innovation was one of the biggest victims of the massive interest rate increase we saw last year. In less than a year, I think 18-fold increase in interest rates. It was like a massive earthquake. And the other victim, of course, was the other very long duration asset out there, long-term bonds. They were hit, at least through October, if my numbers are correct. The long bond market had not seen that bad a year since the 1700s. You know, we're not talking post-World War II. We're talking about the 1700s. That gives you a sense of the shock to the system. And the shock to our strategy was palpable. Boy, we felt it every time Chairman Powell spoke. I don't think we lost many investors. I think the shock to most people is how well we held our assets. Our underperformance started in February of 21 when people were starting to get vaccinated, going back to work, and these fears of inflation started to surface. So since February of 21, we have seen a massive down round in our innovation strategies. And in 21, we had very significant inflows, most of which we kept. I think the net was 17 billion that year. Last year, again, a horrific year. I think for the year, our flagship was, so ARKK, was inflows, more than $1.5 billion. And I think that shocked a lot of people. What we saw was averaging down. Many of our loyal shareholders did average down. And I think one of the reasons they did is we were out there every step of the way, giving away our research, reassuring our clients that actually innovation solves problems. And we have so many problems now created by supply chain problems, the war, created by the Fed, and the demand destruction, which is hurting margins, which technology will solve in terms of increasing productivity. And I think because we are so prolific in our research, our analysts are amazing in terms of the kind of original research they're doing. So our clients and others are reading research from us that they're not seeing from anyone else.
Do you find any of your investors kind of treating ARK a little bit, more cautiously?
I think one thing that happened last year is we were able, with a number of papers, we called it our ground war. We were trying to help investors and advisors understand that if you take a look at truly disruptive innovation, which is all we do, and you look at other growth portfolios, large cap growth, growth generally, as well as the major benchmarks like the NASDAQ, you won't find much truly disruptive innovation in them. And so as we were getting hit so badly, what we also saw is investors taking tax losses in some of NASDAQ and other strategies and moving into our strategy, which was hit so hard because they did believe that we were going to rebound faster. We were hit the hardest. Our research would suggest that the $200 trillion that we expect by 2030 to be the market valuation placed on disruptive innovation, that hadn't changed. That hadn't changed. And so if you have a 5-year investment time horizon, yes, you move into our strategy. And oh, by the way, we are the new NASDAQ, which is one of the ways we were trying to convey, look, if you want to look at the future and truly disruptive innovation, the way the NASDAQ performed in the 80s and 90s,
right.
That's where we went with innovation.
Well,
okay, look through that now. You will not find the kind of disruptive innovation. It certainly doesn't dominate those indexes.
What ARK should be looking at?
Well, when I say we don't own those in our flagship strategy, we do own them in some of our more specialized strategies. But these are the companies that have enjoyed incredible success. They have created big markets. And to move up tenfold, 100-fold from here is going to be difficult. We're not saying they're not going to be successful, but we are saying a few things. Take Amazon. Amazon is not a social network. We have moved into a world of social commerce. So we own Shopify. Shopify is supporting Instagram and TikTok and others that have that are taking really social commerce and scaling it. Amazon will not become a social network. It is not one. It's a good online retailer, and I would put it in a more mature category of online retail. That's not what we do. If you look at Google or Alphabet, everyone's talking about ChatGPT. And we do believe that it is going to put search at risk. Search is 95% of Google's revenues. Now, we also believe, however, that Google is going to harness AI as well. I mean, it owns DeepMind. It is one of the best AI companies in the world. But I think it has been so caught up in fears about legal liability associated with the dangers created by.
What about Microsoft, Cathie? And Microsoft's big investment in ChatGPT, do they have the potential to overtake Google when it comes to search because of the way they are harnessing AI?
I think that's the big threat. I think that's why Sundar went to Code Red at Google. I think they're going to become very aggressive. So yes, we absolutely are focused on what OpenAI and Microsoft are going to do together.